The first Fed decision of the new year, and the world and markets grapple with the coronavirus. Welcome to Bloomberg Wall Street Week. I'm David Westin.
I think was a kind of last hurrah for the central bankers.
One of the things that's kept rates so low is inflation. And so inflation, for a variety of reasons, has been a no-show.
We will see a much bigger variation between companies within the same sector.
And what we're really looking for is the ways that affect the customer today, because this is a customer-driven revolution.
Possibly, China is a form of diversification. There's very likely to be a decoupling between the United States and China.
American workers' outcomes, the American economy's outcomes are determined much more in Washington than they are in Beijing.
Consistency is more important than volatility. So I think it makes a lot of sense for a lot of these institutions to begin to diversify their income streams to get a little more consistency within their business model.
The whole world was watching this week as the Fed and then the Bank of England issued their first rate decisions of the new year. And together they rose up in all their majesty and did nothing. We welcome now our contributor, Stephanie Flanders, Bloomberg's senior executive editor for economics and host of the Stephanomics podcast, and Joe Weisenthal, executive editor of news for Bloomberg Digital and co-anchor of What'd You Miss. And our special guest, Gillian Tett. She's U.S. editor-at-large and chair of the editorial board for the Financial Times, and author also, most recently, of The Silo Effect, The Peril of Expertise, and The Promise of Breaking Down Barriers. So, Stephanie, let me start with you. As I said, the Fed did nothing, basically, but did they really do nothing? Did they signal where they're going?
Well, there was a lot of debate in advance about how much they were going to talk about, for example, what might happen to the balance sheet later on in the year, because that's one of the big changes that's happened, that injection of liquidity into the markets over the last few months. But there was a sort of telling tweak in the language around inflation that they wanted to make completely clear that they were hoping to they wanted inflation to get to the target, not just to be close to the target. And I think that signaled to some that they are moving in the direction of having a slightly more aggressive attitude towards getting inflation back to 2%, which may suggest cuts down the road for 2020.
So let's listen, actually, to what Jay Powell, the chairman, said on that very subject of inflation.
While low and stable inflation is certainly a good thing, inflation that runs persistently below our objective can lead longer-term inflation expectations to drift down, pulling actual inflation even lower. In turn, interest rates would be lower as well, closer to their effective lower bound. As a result, we would have less room to reduce interest rates to support the economy in a future downturn, to the detriment of American families and businesses. We have seen this dynamic play out in other economies around the world, and we're determined to avoid it here in the United States.
So Joe, interpret that for me. Is that saying we're willing to have an overshoot? Is that what that's saying?
I mean, I think there is some willingness to have an overshoot to catch up for a long time of sub 2% inflation. But I think like the long-term change that may be taking place under Powell is a little bit less faith in the models, because I think previously under Yellen and Bernanke, there was this idea, okay, inflation isn't at our goals yet, but the models say it's getting there, unemployment is pushing it there, and so we can start to move to curb it a little bit. And if you look at the press conferences that Powell held at the end of last year, they're getting to be like, maybe let's just see it actually happen, rather than be so confident that just because unemployment is at some level that says we should have inflation, that we can start acting as if it's already here.
Jillian, you have a column in the Financial Times actually addressing this, and we've done a lot of monetary stimulus. I'm not sure we've gotten for it.
Well, I kind of think that people are sort of missing the picture here, because everyone's parsing these words and trying to do the monetary policy version of criminology. But actually, if you look at the fundamentals right now, America has financial conditions which are looser than they have ever been since records started in 1994. That comes from the Fed's own measure, the St. Louis Feds. So the financial stress index is absolutely astonishingly loose right now. You want to know why markets are rallying all around the world? It's because of that. And it's not just because of what the Fed's doing. It's because of Bank of Japan, the ECB. And what's amazing is the Fed has indicated that it's probably going to cut later this year. It's certainly not about to raise. Almost nowhere else is raising right now. And people should be asking, if we've had this much of record stimulus, conditions are even looser than in early 2007, why aren't we seeing more growth?
I mean, it is striking because remember that long debate we had a few years ago about running the economy hot. There was sort of, would the central bank, would the Fed run the economy hot? I mean, by any measure, we're running the economy hot, but actually we still can't get that inflation, and that is why that language was, although it is criminology, that's why that language is important. Is we're saying, look, guys, we are pushing as hard as we can. We are still not seeing inflation come, and we're not seeing capital investment, capital spending pick up, which you might have wanted to see in these kind of extraordinarily loose financial conditions.
Yeah, it begs the question, what economy are running hot? Is it asset value economy, or is it actually real workers out there?
The asset value economy is clearly running hot, but again, I think it comes to this soul searching that's going on inside the Fed and inside economics in general about what really is the relationship between interest rates, financial conditions, and real economic activity. And I do think there's this part of Powell who comes from the business world more than the academic realm. He said it at his last press conference as well, not this most recent one, but previously. It's like, let's see the wage growth. Yeah. Why even talk about full employment or a hot labor market unless we see actual wage growth? And I think, it speaks to this idea. Let's just see it in the data before we start declaring full employment and things like that. There is an important shift going on.
I mean, Powell doesn't eat economic models for breakfast, which is kind of a good thing, frankly, because the leaders who did that for a while haven't got us anywhere great. But something that strikes me is that Powell's done a lot of visits recently to low-income neighborhoods across America. And when you talk to him, he's got this real sense of commitment to trying to make sure that growth is felt by low-income neighborhoods. And conversely, insofar as there actually is wage growth happening today in America, he feels very strongly that you need to protect that and maintain that. And it's very striking because one of the tragedies of what's happening with this super loose monetary policy is that asset prices are rising. That's benefiting wealthy. And meanwhile, it's actually creating a yawning chasm between people who actually are feeling richer and many people in other neighborhoods which are struggling.
Even when real wages are going up at the bottom,
they are,
for a few years, and you have unemployment the lowest it's been since the 60s.
Right. And Stephanie, it strikes me that Jay Powell isn't the only non-PhD economist running a central bank. We also have Madame Lagarde, both of them lawyers, by the way, I should point out.
It's a disaster for us economists. The lawyers are in charge.
But as you look at Madame Lagarde last week, she didn't do anything either, you could say, arguably. But to what extent are their situations different, and to what extent are they quite the same?
Well, it's the same in the sense that they are both entering, or in the case of the Fed, have already a long way through, a basic review of their policy, thinking of some of the things that Joe has said. Have the fundamental relationships changed? Does that mean that we should have a different kind of target? The problem for the European Central Bank is that, at least the Fed has basically met its target. It would like inflation to be a bit higher, but it's got there. The European Central Bank has failed consistently since the crisis to meet its 2% or below 2% inflation target. If you try and rethink your policy in that kind of environment, it's very hard to distinguish what the long-term goal should be from what you should be doing right now. And there's a big disagreement on the Council of the European Central Bank over what to do. So she's supposed to be not imposing a single view. She said she's going to keep everything open. The risk is it could end up being out of her control. Jay Powell knows where his review is going to go. She doesn't know where that's going to end up.
But at least they don't have Merkel and Macron tweeting against them every 5 minutes. That's a blessing.
Yeah, she's best friends with all these people, but then that itself can be a problem. She's a former finance minister. She might be too sympathetic to politicians.
But could it be helpful if she needs fiscal help? Maybe she can deal with these people in a way that other central bankers can't.
I mean, I do think when Lagarde was named as the ECB chief, one very strong argument in her case is that so much of the challenge in Europe right now is kind of on this diplomacy side, right? And kind of, it's like, Germany, spend more money. And given how long she's been on the scene and the relationships that she has with people, regardless of ECB levers themselves, she may be a sort of very good diplomat, so to speak, for that message to fiscal policymakers.
Julian, is that the answer? Germany needs to spend more money. Would that fix your problem? The monetary policy really hasn't gotten the growth.
Well, in its essence, it really is down to fiscal policy now and down to politicians behaving in a rational way that looks to some kind of medium-term strategy. That's not a prospect that many people in the markets are willing to bet on right now.
So will there be some diplomacy between Madame Lagarde on the one hand and the new head, the president of the EC?
Well, she's been talking to them, and she has been saying some of the same things that her predecessor said. Mario Draghi used to constantly say, and he was quite explicit. He said, look, guys, we're doing this. Last autumn, when he announced, the rate cut, they weren't hoping they weren't going to have to do a resumption of bond purchases. They hoped they weren't going to have to do. They said, look, we wouldn't be doing this. We don't think it's ideal. We wouldn't be doing this if fiscal policy was looser in the Eurozone. We would like to see it looser. Right. But there is a limit. That's about as far as they can go. I mean, legally, they are not supposed to get involved in fiscal policies. They can talk in general terms. Even for Lagarde, hard to be specific. Right.
I mean, there is potentially a get-out-of-jail-free card in all this, which is green, which is right now in Europe. Everybody agrees that there needs to be, green policies, Green New Deal, green investment, green infrastructure, call it what you want. And, it's not the central bank's job to start trying to necessarily call for green infrastructure, but boy, is that politically correct way to talk about the need for more fiscal spending right now. Doesn't work in America. I don't think the White House is about to buy that one, but in Europe,
it's fair.
The hunt is on for something that can be good for low-wage workers, stimulate the economy, and help the environment. And there are a few things that you can do.
As long as somebody opens their checkbook.
And last week in Davos, Kristalina Georgieva, the head of the IMF, was actually saying, listen, maybe green spending and infrastructure is going to be one of the things that actually allows inflation to come back if everyone starts opening the green spigot.
Converting lots of gas boilers in people's houses, very glamorous stuff.
But it's a get-out-of-jail-free card. We're here from Gillian. Thank you so much to Gillian Tett of the Financial Times. We're going to have more of their panelists next. Coming up next, a conversation with Anja Manuel. She's RiceHadleyGates co-founder. This is Bloomberg Wall Street Week. This is Bloomberg Wall Street Week. I'm David Westin. Governments, institutions, and businesses around the world are grappling with the coronavirus, which the World Health Organization named an international health emergency. China first reported the outbreak on December 31st in Wuhan, the epicenter of the virus. The country locked down several major cities, barring some 50 million people from traveling. And as the disease spread to more than a dozen countries on 4 continents, Chinese authorities allowed the World Health Organization to send international experts to China to assist with containment of the virus. Some compare this coronavirus to the SARS outbreak in 2002 and 2003, which killed 774 people in 17 countries. As policymakers work to curb the coronavirus, business leaders are taking a measured approach to the issue.
This really is a temporary issue, and we're going to get through it, and we're going to do it. We're going to focus on this in a way that's true to our mission and values.
Our priority focus right now is meeting the demand for our respirators. We're ramping up our production to full capacity.
In terms of our supply chain, what we see right now is a very stable situation. We have safety stocks for all of our key medicines.
And many supply chains are anchored somehow in China.
Most of our key suppliers as well are far away from the center of this particular outbreak. So we feel very good with where we are in the supply chain.
Clearly, China is an important market for us. It's about 15% of our global revenue.
As we think about the long-term growth opportunity in China, we remain optimistic.
Anja Manuel, co-founder of RiceHadleyGates, joins us now. Stephanie Flanders and Joe Weisenthal are still with us. So, Anja, welcome. Good to have you here. Give us your sense right now of where we are on this coronavirus in China. How bad is it?
Well, I just keep looking at the death rates. And while this is a terrible outbreak, certainly horrible for the city of Wuhan, the Ebola virus a few years ago had a 50% death rate. This has 2%. So while it's terrible, I think the government of China seems to be doing the right thing, and hopefully we'll get it under control in the next couple of weeks.
Anja, that's somewhat encouraging. On the other hand, it seems to be more contagious than some other bugs have been. And also, what about this possibility of being able to actually contract it without any symptoms?
Yeah, that's exactly right. I mean, I'm here in San Francisco, and we've got one case here, and they're spreading around the world. You also look at what's happening economically in China, and of course, there's the city of Wuhan, which is 11 million people, is completely shut down, and you can't just discount that.
Anja, something that we've seen that struck me is there was a cruise ship this week in Italy, 7,000 people aboard. Temporarily, everyone was held in place. In the end, there was a suspected case, but the person didn't have it. Nonetheless, the symptoms are probably symptoms that most people get in some form at least once a year. So from a sort of disruption standpoint, even if it's not, people aren't getting it, even if it doesn't spread too wide globally, even if it's not that fatal, it seems like the potential for disruption is massive, just at the fear that every time you cough or have a fever, you worry that you have it.
That's right. And you see the fear already. I've seen some people here on the streets of San Francisco with face masks. That's not usually something you see. As you know, of course, airlines are canceling flights. So I think the reaction to this has been appropriately strong. And hopefully that because people are taking it so seriously, that'll help us contain it and ultimately it'll do less damage.
I mean, obviously, the focus that a lot of people in the markets would have is what impact is this going to have on Chinese growth, but also on companies operating in China, may be very reliant on Chinese workers coming back from their New Year holiday to Foxconn or other places to keep working in tech industries. So I'm just wondering how you see that. I mean, we've done some economists at Bloomberg, we've done some estimates of how we think it could affect the Chinese economy just in the first quarter of this year, and that could have ripple effects for the regional economy. But do you think we're underestimating, you know, if in a week or two's time we find that people are nervous, they're staying at home after their New Year holiday rather than going back to work? I mean, could there be a step shift in the economic impact of this?
There certainly could be. And just looking at the SARS virus from 2003, the Chinese economy, its growth dropped by 2% that quarter, used in the entire Chinese economy. Now, of course, it was going gangbusters then. It went from 11% growth to 9% growth. Now the Chinese economy is already a bit wobbly. And so the impact that this will have, especially on the service sector, on people going out, I think is not to be underestimated. I do think, however, you know, you just had a lot of corporate folks on saying they have their supplies, they think we're fine. I think unless this outbreak goes on for several months, we should probably be all right with the U.S. economy.
Anja, how confident are we in the ability of the infrastructure, the health infrastructure in China to deal with this?
Not very confident. If you've ever been to a Chinese hospital, there are some state of the art and there are many that are not at all. And you see by the Chinese authorities struggling to build a brand new hospital of 1,000 beds in a week, that they're concerned about it. So primary health care in China is still not at all up to Western standards. And I just feel very sorry for all the doctors and nurses who are the first responders here.
I mean, it is one thing you notice over the years that, you know, a lot of the emphasis in the first steps of these kind of crises is on putting everyone in quarantine or stopping transportation. But of course, the real key is are those local health institutions and the first responders, if you like, you know, how quickly can they respond? I do worry a bit. I mean, China, when you think of its attitude towards the internet, towards kind of any form of solidarity among citizens that's not controlled by the state, you know, is there enough sort of social trust and transparency at that local level to make sure that officials are being honest about the figures and working together to try and fix it?
Yeah, I think you put your finger on it. I have never seen a response this open and honest and upfront by the Chinese government. So I have to say, so far, if we can believe them, they're doing a pretty good job. This is the opposite of what happened with SARS. But on the flip side, you know, it's an autocratic state run by the Chinese Communist Party. They've put people in jail for saying worrying things about the virus. They're censoring social media, so you can never be quite sure that you're getting the full story.
Yeah, really good point. Thank you so much, Anja. That's Anja Manuel of RiceHadleyGates. Stephanie and Joe are going to be staying with us. You can check out what's coming up next week on Wall Street Week by heading to Bloomberg Markets' official Twitter account. We'll have a poll each week focused on what you'd like to hear from our contributors. The results for this week are in. The Fed says it's committed to see how climate change will impact finance and economics. Do central banks have a responsibility to mitigate the climate crisis? Just under half of those responding, 48.6%, say yes. This is Bloomberg Wall Street Week. The This is Bloomberg Wall Street Week. I'm David Westin. We're back with our contributors, Stephanie Flanders and Joe Weisenthal, to see what caught their eye this week. And you pointed out something, Stephanie, that I missed entirely about trade.
Yes, one of our very sharp-eyed trade journalists noticed that sort of quite late in the evening at the end of last week, the White House announced that they were going to expand the steel and aluminum tariffs that they'd put on imports of steel and aluminum 2 years ago. And what's striking about that is they're having to expand it, and so it's not just steel and aluminum imports, but actually things made from steel and aluminum. So, really exciting things like nails and staples and cables. But this is an admission that those initial tariffs had not really done what they wanted to do. Obviously, President Trump wanted to help the steel industry and shore up, get them to maybe reopen some of those steel mills that have been closed that he got a lot of mileage of from an election. It had some positive effect on them. It increased their profit margins initially, but actually a lot of companies who needed these products just decided to import the nails and staples and things made out of it, which is what always happens with tariffs. Things always get complicated in trade deals, in trade wars. And in fact, prices for US steel have gone down about 30%. Profits are down. Market cap of these companies are down. So they are not doing a lot better than they were a couple of years ago. I think, the lesson is you don't always get what you want from your tariffs, but you can also end up in this kind of whack-a-mole situation where, if you put tariffs on one thing, then there's another way that the imports will come in, so you have to put tariffs on that. In the meantime, you're massively distorting things for US business people who actually need to use these products.
And the economists, I think, would have told the president something like that if you asked them. At the same time, economists say the trade deficit doesn't matter. We got GDP numbers, actually, the beat to the upside, surprise people. It's because the trade deficit had narrowed. So maybe the president has a point, Joe. It could be right.
I think there is a lot of research that's been done that talks about the China shock and that there really was a degree to which China's entry into the WTO did buffet a lot of U.S. industries. Workers were, in fact, hit by it. I think that part is real. I think, on the other hand, the idea of targeting a bilateral trade deficit with China, to use your phrase, whack-a-mole, sounds exactly right. You could put increased tariffs from goods entering from China, but that could just cause import substitution elsewhere, and in the end, the position remains the same. So I think there is an emerging view among many people that we have made mistakes with regards to our industrial and trade policy in the past, that often U.S. workers have been hurt. But I think there is skepticism that the sort of very numbers-based approach by the Trump administration that, okay, well, if China just agrees to buy more agriculture exports from the U.S., that's going to help things, because then that just creates shifts elsewhere and doesn't really change the dynamic.
But we had another deal. We had President Trump signing USMCA, and that has the rules of origin for automobiles, which are specifically directed to what Joe was just talking about, make sure there's some workers in the United States.
Yeah, and what was interesting about this administration is they came in with at least a couple of advisors who fundamentally disagree with the model of globalization that big U.S. companies have followed for the last 10 or 20 years. This idea that you have very disaggregated supply chains, you go to the cheap, you're outsourcing to China and everything. The U.S. had been the biggest cheerleader for that, and I thought it has been a very striking feature of this administration that they have either considered or done things that explicitly go against that model. And I get, but the one problem is, there's not part of an overall discussion around the future of globalization, or how do you protect workers from the impact of globalization. It's this somewhat more random, the White House wants to keep charge of everything, really just wants to beat up on people and have control over the rules. Those rules of origin, they want the White House to be able to, by its own discretion, change them. Literally change them. And which you can imagine.
By plant, state by state.
Which you can imagine the companies who already worry about where the next tweet might come from, that is quite a stick.
Well, also thinking about it from a market perspective, as your point reminds, this story is not going to go away. There's going to be trade headlines all the time that are going to keep people on their toes.
That's for sure. We'll be back with our contributors. Head to Bloomberg.com for more exclusive thoughts from our weekly contributors, along with full episodes in the official Bloomberg Wall Street Week podcast. This is Bloomberg Wall Street Week. Welcome back from New York. This is Bloomberg Wall Street Week. I'm David Westin. The last 4 months have seen a remarkable run for American tech companies. Alphabet is now the third trillion-dollar company, joining Microsoft and Apple Amazon is expected soon to follow. For the industry's biggest names, this week was the busiest yet for earnings. Apple, Facebook, Microsoft, and Amazon each reported after hurtling into earnings season with almost unprecedented momentum and value up by more than $1 trillion. While Apple and Microsoft received passing grades after easily topping analysts' forecasts, Facebook didn't fare as well. The social media company delivered results that failed to live up to the hopes that fueled its 25% rally since September. It could be evidence that fundamentals like valuation still may matter in the marketplace. Our contributors are back with us, Stephanie Flanders and Joe Weisenthal. So, Joe, tech has been driving this market for some time. Can it keep going?
I mean, the extraordinary thing that defines these tech mega caps is that they get better as they get bigger. And so you typically think about economies of scale or diseconomies of scale and companies get more efficient. But the larger Facebook gets, the larger Apple gets, the larger Amazon gets, et cetera, the more data they have, the more they can refine the product. And I think that's the main reason why people have been so stunned by the extent of this rally, because we're just not used to seeing companies get better and more competitive as they get larger. And so, look, can they get going? I don't know. If I knew, I might not be here. But I do think that there are conditions of their growth that have just really surprised people. And in a way, you sort of, people have been very foolish calling the top of all these.
So, Stephanie, has the network effect just changed business as we know it? Changed the economy as we know it?
We know it's turned economics on its head because you have these increasing returns to scale. You are supposed to have, diminishing returns at some point, and it just obviously hasn't worked that way. I guess in the context of the stock market, we should remember, what we were saying at the start of the program, which is these are extraordinarily loose conditions. So investors are being pushed into buying stocks. So then if you're already in that position where there's a great incentive to find stocks that you want to buy, I think that tech is sort of benefiting from the fact that they have delivered the earnings by and large. This isn't just about re-rating. This has also been about, I think, the biggest companies have raised their earnings by about 40% over the last 2 years. We've got, they are doing incredibly well in terms of margins. So I think it's not just, there's a combination of, there's something specific about tech that gets better as it gets bigger, but also that how they look relative to this other environment in such a loose, an environment where people really are being encouraged to get into stocks.
So they're making more money, I understand. Why doesn't it become overvalued? Because traditionally markets go too far and they overvalue and there's a correction.
Well, who's to say that they're not overvalued right now?
Well,
this is like the problem.
Well, I think there's two things that really speak to Stephanie's point, and I think one of the defining images of everything, but particularly the market these days, is this idea of the barbell. So you invest in the fastest growing companies in the world, Amazon's, Facebook, Shopify's, and so on, and you buy German bunds and U.S. Treasuries yielding 1.5% or 2%. No one wants that middle. No one wants the companies and that's just like the sort of safe GDP-linked growth that you might get from some industrial. So you buy the safest stuff and you buy the riskiest stuff. And I think that's kind of, you're pushed into these companies that have their own secular growth stories, their own compelling things, because the overall economy itself is kind of mediocre.
And that is this sort of bizarre thing where we just, all these years, we're talking about the wall of worry and the unloved rally, and yet you see the market going to these all-time highs. And it is the case that you have this deep pessimism and concern that you see embedded in now negative real yields again. The Treasury has gone lower and lower over the last year, Treasury yields. And at the same time, this sort of optimism and mania about the tech stocks. The two are coexisting in this barbell.
The other thing, and you asked about overvaluation, and maybe they're overvalued or not, but most investors will say overvaluation is not in and of itself enough to get a sell-off. Something has to catalyze it, and the thing that usually catalyzes a sell-off is a recession. But you usually don't get a recession until you get overheating in the economy, and what we've really had for 10 years is this sort of it's okay growth. Not recession growth, but nothing that's really going to make central banks want to slam on the brakes. So it's kind of like, it's a cliche, but kind of this Goldilocks environment where it's just not strong enough to get that recessionary response.
Well, this is a fascinating point. It's a different kind of barbell. It's sort of like get really high asset values, but pretty modest growth. That normally you say that doesn't sound so healthy, but maybe it sustains.
And coexisting with these treasury yields that you really wouldn't normally say were healthy. I mean, what is going to get real yields back up? It goes back to the conversation we had right at the start about inflation. But as things stand, you know, we've been flirting this week with the inverted yield curve again. The fact that the long-term interest rates are getting shorter than the short ones.
So what does this mean for Ben Graham and Warren Buffett? Value investing just gone? I mean, I thought that was the way to go. Is that just written out of the Lamb's Book of Life?
I mean, it is interesting how much money will have been lost. I mean, you know, a few years before I came to Bloomberg, I was at JP Morgan, and every year there was that debate. Surely this will be the year for value. You know, and value has never been cheaper. It's never been more attractive. And you know, arguably look at the whole of Europe and say Europe is looking very value stocks right now. But again and again, the growth comes through, and I think that is as a feature of this curious environment, economic environment. Until that changes, I think investors will be very nervous of changing their strategy.
But Joe, this has ramifications well beyond the investing class.
Yeah.
This has ramifications for employment, for capital formation, things like that. Because if you end up with it all being intellectual property and a relatively few people having huge capital. By the way, they don't need to invest the capital. It's not like they need to build plants and buy equipment and things like that.
Right.
It really changes the economy.
Oh, there's so many ways that is changing and going to change the economy. I mean, one thing that doesn't get that much discussed but as you said it exactly, is the sort of the inequality that's a result of, like, one person goes to work out of college for Facebook and another person goes to work out of college for FedEx or something, and you know, the person who went to work for Facebook is going to make a lot more money. The degree to which one's own fortunes are tied to the success of the firm, and if that firm is done phenomenally well, all kinds of interesting ramifications that I don't think we're used to seeing in previous regimes.
So, Stephanie, the perception, at least, is that we haven't seen the same kind of tech phenomenon in Europe as we have in the United States. Has that led to something of a divergence in the two economies, or at least in the two marketplaces?
Well, you've certainly seen it in the markets, and that's what's interesting, is when you actually go into the composition of of the difference between the European stock performance and the US performance, actually, it's not so much that their individual sectors have behaved so differently, it's just the tech sector is so much smaller. And actually, and it is also that European financials have tended to do worse. But that was just a big part of the market that's missing in most of those European markets. And it has made a difference. And of course, it's something that a lot of European policymakers have a lot of angst about. They feel that whenever, there is dynamism in these tech sectors, but any sensible, German tech person wants to get bought out and immediately head off to San Francisco.
And so the French say, how about a digital tax?
Yeah, right. I guess that's one way to
It's just a coincidence it goes
back
against U.S. companies.
Right. But no, to your point exactly, it has confounded a lot of people in the markets because they're like, oh, surely this is the year that international stocks are going to outperform the U.S. stocks, or EM stocks look so much cheaper. But in the end, what they're making is a stealth tech call, and they don't even realize it, because all they're really saying is that non-tech stocks are going to outperform just because so much of the tech value is on U.S. indices.
Okay, we will be back because we want to get a second opinion on all this. On the record run of U.S. tech stocks, we're going to turn to Cathie Wood, Ark Investment Management founder. This is Bloomberg Wall Street Week. This is Bloomberg Wall Street Week. I'm David Westin. The rally in tech stocks gets some of its support from fund managers who don't want to be left behind, but some also lead the charge. Cathie Wood, founder, CEO, and CIO of Ark Investment Management, is known for her bold calls on tech companies and active funds that invest in disruptive innovation. She joins us now, along with Stephanie Flanders and Joe Weisenthal. Welcome, Cathie. Good to have you here.
Thank you.
We've just been talking about Facebook and Google, Alphabet, things like that. Those are obviously huge successes. What's the next Facebook? Give me a tip.
Well, you're right. Those are trillion-dollar or approaching trillion-dollar companies. And so we don't own, actually, in our flagship fund, any of the FANG except for Netflix, because we are all about finding the next big thing. So the next big things involve our five disruptive innovation platforms. So DNA sequencing, robotics with collaborative robots, energy storage, electric vehicles, think Tesla, artificial intelligence. You can also think Tesla on that, but you can think about every company when it comes to AI. And then finally, blockchain technology. So we've had a lot of news on all of them, including blockchain technology and Square's positioning in that space.
So we'll come back to Tesla in a minute, but first of all, talk about genomics.
So genomics, we think, is the most underestimated and misunderstood of our disruptive innovation platforms. And the reason is we have never been able to really cure disease. Now that we're able to isolate mutations through DNA sequencing, think Illumina, that's the foundational stock in this space, we are able to understand where the programming errors in our genome are. And with CRISPR gene editing, increasingly we're beginning to believe we're going to be able to correct those programming errors. I'm going to give you a comparison today versus the tech and telecom bubble. If I had told you in the tech and telecom era that there would be 3 foundational stocks in the CRISPR-Cas9 gene editing space, they own the patents. I would have told, and that they'd get a 10% royalty probably on any therapy derived from CRISPR-Cas9. They, given that we're talking about curing disease here, curing pediatric blindness, curing sickle cell anemia, beta thalassemia, leukemia, they probably would have accumulated to $200 to $300 billion in market cap. Today, the 3 stocks, Editas, Intellia, and CRISPR Therapeutics, can barely manage to get to $5 billion cumulatively. This is so misunderstood, and so we think it's, again, inefficiently priced.
I have sort of a practical question here. I mean, if somebody says, okay, we're going to have Facebook and we're going to have everybody communicate with each other and be friends, I can sort of understand that. Do I need to be a biophysicist or something to understand this area? I mean, because that might be an interference with capital formation, actually, because I just don't understand it well enough to know whether to invest or not, or which one to invest in.
It is a great question. There is a lot of fear because of a lack of understanding, and it also seems so complicated.
It does.
So one of, at Ark Invest, one of our missions and values is to educate. And I think Simon Barnett, our genomics analyst, is going to start a program, a series called Simon Says, or something like that, to actually break this down and help people understand it, because it's so important.
So one of the things that strikes me as unique about your approach in your fund is that you're into, you do stock selection, and it's kind of out of fashion, and everyone's macro, and everyone's long S&P and long treasuries. We were just talking about the sort of end of this Graham Dodd world of people looking at individual stocks. Is there, in your view, is stock selection just have to be sort of reinvented so that it's not about, oh, this company trades at an 8 PE and it should be at an 11 PE, but really thinking much more deeper and long-term and cyclical and secular, the way you're sort of looking at it?
Thank you, Joe. Actually, we think that 2 things are happening here. Post the tech and telecom bust and the 08-09 meltdown, there was an accelerated shift into benchmark investing, passive investing, benchmark-sensitive investing, to lower risk, the risk that the portfolio managers and analysts were taking. In the world we believe is evolving, one of the most dangerous places to be in terms of the kinds of returns possible out there is in the indexes, because they are being populated increasingly, we believe, by value traps. They're cheap for a reason. I mean, if you look at whether it's banks, energy, auto companies are in massive trouble, pharmaceuticals, if they don't change the way they're doing things. Even rails, we think autonomous truck platoons are going to take the place of rails, or be cheaper to transport freight. So anyone hewing to the benchmarks, which are very backwards looking, they're not about the future. They are about what has worked. We're all about what is going to work. There's a second component to this, and you raised it, time horizon. We're playing an arbitrage between, we're arbitraging, the short-term time horizon that most investors and analysts have next year, maybe, quarter sometimes, compared to our 5-year time horizon. And I can tell you with a straight face that if you give us 5 years, that Ark Invest is a deep value manager.
You mentioned the car companies are in trouble. There's one car company, at least this week, is not in trouble. That's
Right.
Tesla,
Yes.
that you're invested in.
Yes.
So explain Tesla to me. I understand it's a really great car, and it's really terrific. It's really forward-looking. If you look at the number of cars they make compared to the value of the company, compared to any other company, it's crazy.
Well, we just published a report with our, again, long-term forecast. And the numbers have gone up dramatically. And yet, we think it's incredibly undervalued. And the reason for that, there are two assumptions that have changed with in the last couple of reports. One, our bull case for Tesla in our old model was that it would lose a third of its market share. It had in 2018 17% global market share, including China. That it would lose as the Tesla killers came into the market, Audi and Porsche Taycan and Jaguar. Well, guess what? Its share increased last year to 18%.
So do you think Tesla can have 17 or 18% of the worldwide market when it's all electric vehicles? Is that what you're saying?
And if we are right, this stock has only begun.
But that makes you think that this isn't actually a vote for Tesla. It's a vote in all these other established car companies completely failing to make the crucial transition, which they've known for several years they were going to have to make. I mean, can we really be that pessimistic about the likes of BMW?
They're failing miserably, and in battery technology. They're not writing down the consumer electronics cost curve, which Tesla decided to run down, and people made fun of them. Oh, you're putting cell phone batteries at the bottom of the car, cell phone batteries that blow up? No, they chose lithium-ion pouch, which is much more costly than Tesla's consumer electronics batteries. So if they want to compete with Tesla, they'll have to sell every electric vehicle at a loss. At the same time, they're losing their internal combustion engine business. The reason this is going to happen is because within the next 18 months, 2 years, the price of an electric vehicle, like for like categories, is going to drop below that for a gas-powered vehicle for the first time. And it will continue to fall because we're riding down the battery cost curve decline. So the traditional auto manufacturer, if you look at their R&D budgets, or you look at GM's, 10% of its R&D, $25 billion in capital spending, is allocated to electric. They should be at almost 100 now, given what's about to happen. And I think the reason Berlin, Germany, invited Tesla to build a factory 200 football fields, either soccer or our football, that big, is because they know they're in trouble. They've got to adjust, or else they're going to lose a tremendous number of jobs.
Don't you think it's a little early to count the traditional companies out of it? I mean, they haven't really almost gotten started.
So
the Taycan is how old?
That is the problem. That is the problem. They have just gotten started, and what they have delivered are cars that don't even meet, whether it's range or other metrics, the Model S circa 2012. Now, of course, there are three other advantages Tesla has. So batteries, one. Second is they have their own artificial intelligence chip. And our analyst, James Wang, who worked at NVIDIA, the artificial intelligence company, for 8 years, looked at the specs of this chip and said, oh my gosh, they're 4 years ahead of any other auto manufacturer in terms of the specs out there on chip technology. And that's important because we're going autonomous with electric. And autonomous is an artificial intelligence project, right? The winner will have the most data and the highest quality data. Tesla has 14 billion miles of real-world driving data today, and the closest competitor, Waymo, has 20 million. So and then the last is Tesla is the only auto manufacturer still that delivers over-the-air software updates to modify performance.
You're going to need to do your next show from Detroit just to even things out.
Yeah, I can hear my friends in Detroit really good yelling at the TV set. But Cathie Wood, I think it's fair to say, is not just a stock picker, she's a stock believer. She's not selling her Tesla stock anytime soon.
It's great research.
It's great to be with you with us, really. Cathie Wood of Ark Investment Management and Bloomberg's Joe Weisenthal. Stephanie Flanders is going to be staying with us. And if you missed an episode of Bloomberg Wall Street Week, full episodes are now available on YouTube, the Bloomberg Terminal, and Bloomberg.com. This is Bloomberg Wall Street Week. Welcome back to Bloomberg Wall Street Week. I'm David Westin. It's now time for some final thoughts from Stephanie Flanders. And Stephanie, our final thoughts have to be about Brexit. It is finally here. I feel like we've been waiting forever. Brexit's here. What does it mean?
Oh, well, we shouldn't forget it means the first country to leave the European Union since it started, which is no small thing. And it's the third biggest economy in the European Union. So there'll be plenty of people in Europe who will be pretty sad about this moment. Obviously, Boris Johnson is not one of them. This is supposed to be a bright new moment for the UK. And it's fair to say there has been a bit of a Boris bounce in terms of investor sentiment. But, you know, as was indicated subtly by the Bank of England governor this week after the Bank of England decision, you know, the hard part starts now. It's almost the opposite of the coronavirus we've been talking about, where there's a very short-term hit to the economy. It's very visible. It inspires a lot of activity and action and concern. This has been a sort of drip slowing down of the economy ever since the referendum, which could well continue. We've seen actually one of our economists say the economy is already 3% smaller than it would have been if we had not voted to leave, and nothing has happened in terms of trade rules. And the Bank of England has some pretty grim forecasts for the economy over the next few years, partly as a result of Brexit when they had their meeting this week.
And you raised trade rules. There are so many relationships that have to be renegotiated over the course of, they think, 12 months. The chances of that, I'm not sure.
Well, of course, the single most important one by far is the relationship with Europe, which even the quite sort of gloomy Bank of England forecasts assume a pretty deep, pretty good deal, which actually the European leaders have tended to say is not possible within 12 months. These things usually take years. So I think there's a concern about that. Of course, the government will say, well, we're going to have lots of deals with the US and China and elsewhere. You know, we worked it out. You need 7. If you want to make up the loss from having all the great situation of being in the European Union, you need 7 deals with the US. And unfortunately, there is only one US. So this is going to be tough.
And as you say, it is a sad moment, I'm sure, for the European Union. At the same time, one thing that was predicted or feared did not happen, which is sort of a run on the Union. We thought that all sorts of other people would say, OK, I want out too. We haven't seen any of that.
No, and actually, I think that the parting gift that the Brits have given to the EU is to provide an example for others which they realise they really don't want to follow. I mean, if you were thinking about possibly having a referendum or voting to leave the European Union anytime soon in 2016, you look and see the pain and suffering the UK has been through, the wrangling in Parliament. I mean, there is no government that will go down that road. And actually, we've seen European attitudes have become more positive towards Europe. So we've done them a favour. We've shown the value of the European Union, even as we leave.
I'm sure they'll write you a thank you note, without a doubt. OK, thanks so much, Stephanie Flanders, for joining us this week. This has been another edition of Bloomberg Wall Street Week. See you next week.